The global economic crisis has put a strain on a number of ongoing initiatives in the banking industry. It is not as if the banking industry was caught unaware. Initiatives like Basel II, corporate governance, the accounting professions, IAS 39, and several others that we need to keep and in context, especially in today's environment. Malcolm Knight was General Manager of the Bank for International Settlement from 1st April 2003 to September 2008. From 1999 to 2003, he was the Senior Deputy Governor of the Bank of Canada. From 75 to 99, he was with the IMF. And now he is the Vice Chairman of Deutsche Bank, so he is on the business side of the equation. Malcolm, the first question to go into is this whole area of Basel II. Where are we today?
Well, I think the first thing to say is that in the run-up to this crisis, of course, no banks were on Basel II. Basel II was developed to make banks' risk management much more sensitive to developments in counterparty credit risk, market risk, operational risk, and so on. And the systems that banks have had to develop in order to implement Basel II, I think will serve them very well going forward. Now, that said, I think there are some elements that need to now be reviewed and looked at again. One issue, as you pointed out, is that the current financial system is highly pro-cyclical, much more pro-cyclical than it used to be, because of the interaction between banks and other financial institutions in the marketplace. That means that both funding liquidity and market liquidity can dry up at the same time. It makes risk management much more of a challenge. So I do believe that going forward, regulators are going to need to do a number of things. First of all, and the Basel process has always fostered this, financial regulation must be internationally consistent. A global financial system requires globally harmonized regulation and consistent supervision. Secondly, I think that all financial regulation has really focused up to now on what I would call macro-prudential regulation of individual institutions, which implicitly assumes that the risks that cause a problem are idiosyncratic risks. But we see now that the risks can come very much from the linkages within the system. And I think this means that we have to have macro-prudential supervision. And the discussion of dynamic provisioning, building capital cushions in the upswing of the credit cycle, these are all elements of macro-prudential regulation. How we're going to do that is going to be a very big issue, but I think it's very important. Final point I would make, the Basel process, is that innovation clearly occurs so rapidly, and crises can develop from unexpected quarters, and therefore it's going to be important to have a Basel process which can adapt more quickly in its regulatory structure to financial developments.
Right. Now, that immediately puts the limelight on the regulators themselves. In this marketplace, it appears that the regulators that have been more successful are the ones whose mandates are much more focused, either on the institutions or on the markets, on the monetary side of issues, and how these regulators talk to each other. Would you recommend that the world moves towards a form of a unified regulatory model, or do you think that the kind of models where different disciplines are managed by different bodies is the way to go?
Well, I do think that we have to have, as I said, we need consistent regulation internationally. When we look at the individual jurisdiction, however, it's quite clear that the scope of financial regulation has to be broader than it's been in the past, because the legal status of an institution doesn't necessarily determine that its activities are going to be any different from an institution that's set up as an insurance company rather than a bank, etc. And therefore, I think that we have to have consistent regulation across institutions and markets. and infrastructures within each jurisdiction. Now this, I think, does argue for an integrated regulator or a Twin Peaks regulator, with one regulator doing safety and soundness regulation and another doing business conduct regulation. But actually, one might argue that in the situation in the United States, some weaknesses in business conduct regulation actually morphed into a major financial stability problem.
But that has
so we need integrated regulation.
Right. Take the case of the UK. Where do you think the UK went wrong with Northern Rock, where you had the FSA on the one hand, you had Bank of England, dealing with issues which had more to do with liquidity, market liquidity, whereas the FSA was looking at the institution itself?
Well, I think you have to remember that Northern Rock just happened to be the first prominent one, and of course when a situation like that happens unexpectedly, you have to learn by doing. I know that from doing systemic bank restructuring here in Asia in the late 90s. I think the issue with Northern Rock goes back to this point about macro-prudential supervision. Northern Rock appeared to be a relatively well-capitalized institution, but it was engaging in a great deal of maturity transformation, and it was getting its liquidity in the wholesale markets. Now, this is actually a model which tends to be quite unstable. The stock market saw that in the UK long before Northern Rock had its problems, but this was not the focus of regulatory oversight at the time. And so I think this is a case which illustrates the point I was making, that macro-prudential supervision has to look at the interactions among institutions in the marketplace and not just specific regulatory criteria.